Egg yolk, what is the word with those who never miss an episode? The Chico Army, and if you're new, a viewer of the tube. My name is Tyler, the host of the crypto channel that every episode puts on a killer show, but there's something about it that always makes you feel weird, kind of like this pole dance.
Oh, so charming, it's a lovely that I hardly can believe I'm free.
You know our double D's, Danny DeVito's. It's time for Chico Crypto. Well, we have to finish the week off with talking about the news that shocked the nation. The economic quarterly report was released and US GDP dropped by the largest percentage on record. It fell by a drastic 9.5%, making years past drops and contractions look small in comparison. Now, if you don't know what GDP is, it stands for Gross Domestic Product, and it's used to track the health of a nation's economy by broadly measuring and valuing the goods and services produced by a country. Out of all the world's countries, the US has the largest sole GDP, but regionally, Asia and Europe are bigger than North America. But the US, it got hit, and it got hit the hardest out of the top nations. From quarter 1 to quarter 2 of 2020, the US lost 1.8 trillion. And damage like this is only comparable once in American modern history, and that is of course the Great Depression. GDP got crushed, down 8.5% in 1929, down 3.4% in 1930, collapsing a brutal 12.9% in 1931, and a modest negative 1.3% in 1932. 4 straight years of collapsing GDP, which finally rebounded in 1933. So, Great Depression, part number 2, about 100 years later, as things seem to happen in cycles, if you know what I mean. That is why 1 year ago, I made this video, Global Economy is Destined to Collapse. Then 10 months ago, I put out this video, Next Recession to Destroy Millennials. Bitcoin fights back and secures your wealth. After that, 9 months ago, this one, Realistic Bitcoin Prediction as a Global Recession Nears. Countdown begins. And finally, when the collapse came, this video, Are you now ready for the next Great Depression? It was kind of obvious, even before this Mayan Chirona, that the markets were overinflated and the virus was just the pin that popped the bubble. And now the ugly economic slowdown is showing itself in every measurable data point about the economy, including that GDP. Unemployment is still above 1 million claims, as 1.4 million were filed last week. And business, it's come to a standstill. Closures began rising and rising throughout March, and then kept going and going throughout April, and then peaking in that month. Since the numbers of closures has been fluctuating, but as of July 10th, over 132,000 businesses are still closed, mostly small businesses. Now, some people might be like, hey, that's a good thing. Since April, 40,000 businesses have reopened. Yeah, but for how long? And the worrying thing is permanent closures, as they're coming in hot out of those business closures, meaning they are never coming back or not for a long time. 55% of those 132K are now permanent, and the trend line since March has been up and up. You know what that means? Out of those total closures, 45% are now temporary, meaning in a perfect world, only 59,000 more businesses would open. But as we know, this is not a perfect world, and many of those that are in the temporary category are on the brink of permanence. Which is absolutely worrying, because small business makes up 52% of the workforce, dominating the large firms with employees scattered across all 50 states instead of localized in corporate headquarters. Yet the share of large business, which is 48% of the US workforce, is doing pretty good. They received a large bulk of the handouts. The shares of their companies are being artificially inflated. Thus, the employer stock plans of their company drones, it's holding strong, which is seen in the only part of the economy not stuttering, the stock market. It just keeps a surging and a surging since the March crash low. And shoot, expanding out the chart with the crash included, things aren't so bad, as since 1 year ago, the markets are only down 3.16%, pretty much back on par, like at the end of July 2019. But back then, we didn't have rapid unemployment claims, small businesses about to go under, which which equals more unemployment claims, which means you darn corporations, which employ the other 42%, are gonna have no one to buy your products or services here soon. Unless you bail the people out, keep that unemployment going, but for a whole hell of a lot more people. You created money for you guys in the corporation, thinking it might trickle down, but it doesn't. You gotta trickle up, especially in a situation like this. And the dumbass corps don't realize it. They are just delaying the inevitable. Small business employs a wide range of people who buy up their products, buy their cars, fly on their planes, spend their hard-earned money, usually with no 401k, no health plan, majority on their products. Lower the income, the higher consumption on everything from necessities to luxuries. And even our Fed knows it, and they have for a long time. In a November research paper titled "Do the Rich Save More?" it states this in their paper: a roomful of economists would be less easily persuaded that higher lifetime income levels lead to higher saving rates. The typical economist would point out that people with temporary high income will tend to save more to compensate for lower future income, and people with temporary low income will tend to save less in anticipation of higher future income. Thus, even if the saving rate is invariant with regard to lifetime income, we observe people with high current income saving more than their lower income brethren. That quote came from Milton Friedman in 1957. So right now we are in a sticky situation.
Now that's what I call a sticky situation.
The wealthy and their businesses are in the ultimate save mode in the anticipation of lower future income from general sources of revenue, selling goods and services to those who consume. And those who consume the most are the ones who receive that measly stimulus check, and most have spent it, and a large majority was consumption-based, as the situation wasn't dire yet, and for some in this category, it's still a joke. Well, in my opinion, things are about to get dire. The clocks are about to tick into August, meaning a last full month of summer. That summer of euphoria I'm talking about. Which you can tell is not ending from the one-day Dow Jones chart. It's hilarious. Worst GDP news on record, the measure of goods and services, consumption, health of an economy, yet it can't phase Stonks. If that news won't plummet it right now when Trump's in office, I don't think much will, because who is the one tasked with the duty of saving that stonk market? Who is the one the feds have enlisted? BlackRock. And BlackRock has traversed from administration to administration, left to the right, George Bush, Obama, and now Trumpster. And you want to know what is funny? Larry Fink, CEO, was planning to join Hillary and take over her treasury. The Intercept covered it in 2016. Larry Fink and his BlackRock team poised to take over Hillary Clinton's Treasury Department. But as we know, that didn't work out. So switch sides, why don't you? They are the same anyways. And can you trust what BlackRock is building, the corporate fourth branch of the government? Well, the BlackRock Transparency Project covered it in their article titled "New Report Details How BlackRock Built Its Mexican Infrastructure Businesses Through Cronyism, Corruption, and Conflicts of Interest." Cronyism, corruption, and I like the word greed over conflicts of interest, because those seem to be three words which describe the current system called Finance 1.0. But I'm sure some of you are asking, but Tyler, how will Finance 2.0 fare if the system of old is about to go kaput? Well, that's a good question, which we will have answers to soon enough. Bitcoin, crypto, DeFi, tokenization versus stonks and 401ks. The old versus the new. Old versus new? Well, just look at ownership rates of Bitcoin taken in the spring of 2019. 18 to 34 age range, 18% claimed to own some. 35 to 44, 12% claimed to own some. And then it shrunk big time to 4% for 45 to 64. And 65 plus, only 1%. Now who owns stonks? Mostly higher income people, as they are not consuming their wealth, but saving and building it. How about those 401ks? Well, small businesses don't usually offer it, so around 52% of our population is shot out of luck. It's the big companies, large employers, and guess who is relying on that to retire from those companies? The older generations, as Gen X and baby boomers' average value dwarfs millennials, and those younger, not even a value worth looking at. So it's obvious to me there's going to be a clash of the old and the new. Some of the new will fight the old, and some of the old will fight the new. It's those that are able to adapt both ways that will come out on top. So buy Bitcoin. Okay, boomer? Cheers, I'll see you next time.